Good day, and welcome to the DoubleLine Total Return Webcast, hosted by Jeffrey Gundlach. Today's conference is being recorded. At this time, I'd like to turn the conference over to Ron Riddell, President of DoubleLine. Please go ahead, sir.
Well, thank you, and good afternoon, and welcome to the DoubleLine Webcast with Jeffrey Gundlach and Andrew Hsu. Title of today's webcast, Cave People. I want to briefly talk about some of the content that just came out here on DoubleLine. If you go to our YouTube channel, /DoubleLine, our very latest Channel 11 with Ken Shinoda was just released. Here, Ken Shinoda discusses the state of the markets with a play on the title of Led Zeppelin's 1969 song, Good Times, Bad Times. Also within that YouTube channel, Morris Chen, our portfolio manager of the DoubleLine CMBS and CRE debt team, is on with Charles Payne. So please view those. Go to youtube.com/DoubleLine Capital. Also wanted to highlight, we have a new LinkedIn platform with our portfolio manager, Sam Garza, and two of the analysts, Ryan Kimmel and Fei He. And it is called Between the Lines, and it focuses and analyzes the current financial markets with a focus on 2024 trends. If you want to view the rest of the webcast schedule of the year, you can go to doubleline.com. And upcoming webcasts, I want to highlight April 9th, Diversified Fixed Income webcast, and then on May 13th, the Smart Beta featuring CAPE, the new ETF. Although not new anymore, it's almost 2 years old. You can follow us at our X handle at DLine Funds as well. Not only do we have the Channel 11 on YouTube with Ken Shinoda, but we also have our two podcasts, the Sherman Show podcast with Jeff Sherman and Sam Lau, and Minutes podcast, which is now live on X Spaces every Friday at 1 p.m. with Sam Lau and Jeff Mayberry. And lastly, on the YouTube, to highlight our product specialist team, we have a series called Perspectives on that YouTube channel. Just briefly, we'll be talking about throughout the webcast, the DoubleLine Total Return Bond Fund, and here you can see the different share classes and expense ratios. We have three share classes: institutional, retail, and our retirement share class R6. To highlight the standardized performance in the DoubleLine Total Return Bond Fund, since inception, and the inception of the fund was April 6th of 2010 through 2/29 of 2024, the annualized return of 3.68% versus the Bloomberg U.S. Ag Bond Index at 2.25, an annualized outperformance of 1.43%. So with that, I'm going to turn the webcast over to Mr. Jeffrey Gundlach.
Thanks, Ron, and thanks everybody for joining us. Here's the second webcast of 2024, and we always do the Total Return webcast in March. So let's get started. You can see that the slide is a little different than the cover slide, with the title of this webcast is Cave People. And what the photo that's on the screen now is, amazingly, fairly recently, they discovered that in Modesto, California, there are people living in caves. I guess they're not homeless exactly. It's not much of a home. You can see these caves were pretty elaborate in terms of furniture. They were hanging things on the wall. And it reminded me of about 20 years ago, I went to China to do a financial conference. And we were staying in Xi'an, China, a second city in China. And we were driving out to visit a tourist site. And on the way, the tour guide said, look out the window. You see those caves. People were living there as recently as about 10 or 20 years ago. And it was such an astonishing thing to hear that people were living in caves. And here we have in Modesto, California, people had been living in caves. They cleared them out because they feared for their safety, because these caves were dug into the side of a riverbed, and they were afraid that it was going to collapse. But it made me think about also Plato's Republic and the Allegory of the Cave, where Plato's older brother, Glaucon, is talking to Socrates, and per usual, it's narrated by Socrates, and he talks about an idea that maybe there are people that are chained inside of a cave, and they're chained there from a very early age, and they can't move their legs, and they can't move their necks. They're just forced to stare at a wall in front of them, and behind them is a low wall that hides the people that are walking back and forth behind it, but the people are carrying something, and behind that wall is a fire, and the fire casts the shadows of the objects that the people are carrying onto the wall, and these people chained in the cave see the images, the shadows on the wall, and they actually think that it's them. They don't realize that it's just an illusion, it's not reality. And one of them gets out of the cave and is blinded by the sun. And it takes him a long time to get his vision back. And he decides he wants to go back in the cave because the real world is so much better than living in that cave. But unfortunately, the people that see him come in, he gets blinded again because now it's dark and he's got to readjust his eyes. And the people see that he's blind and they think he's absolutely blind, and they refuse to leave the cave because they don't want the negative outcome, even though it's a much better outcome. That's why the guy came in to try to save them. It reminds me of those goggles that people wear, virtual reality goggles, where they don't want to deal with reality. They want to live yet another layer removed from reality. It makes me think about how many layers people are becoming removed from reality. And of course, that's the way the news works these days. And it's the way, of course, politicians have probably always painted the tape more optimistically than it really exists. But there's an awful lot of that going on as well. So let's talk about how we're all sort of living in caves as we go through this presentation. I've divided it into a small section on the deficit and the debt, which I've talked about at length, so I'm not going to pave that road yet again with that level of detail. Then I'm going to talk about some recession indicators, including employment, which is a big piece of the economic puzzle. And then we'll talk about inflation. The CPI came out today. It was a little hotter than expected. We've got core at 3.2 and headline at 3.2 and core at 3.8. I think I've got those in the right order. We'll see. And then we'll talk about bonds, and Andrew will go through the detail of the total return bond fund. So let's get started. It's interesting. This is the budget deficit as a percentage of GDP on a rolling 12-month basis. And the administration just came out with their forecast for the 2025 deficit. And even though we're running a 6.3% deficit as a percent of GDP as the most recent quarter, as the end of January, the prediction is that we're going to have a 6.1% deficit as a percentage of GDP per the administration in 2025. And that seems to me to be kind of scary. We're supposed to be in an expansion, and we're running historically high deficits as a percent of GDP. Should we fall into a recession, and I talked about this in my Just Markets webcast, we're going to have the deficit go to a double-digit, very likely, percentage of GDP. And this is a problem because of the way that the interest rates have gone up. Let me just put this recessionary movement on budget deficit in context. The dotted line is the U3 unemployment rate. And the red shaded area of the underneath the line is the U.S. budget deficit. And those, as always, the red shaded bars are recessionary periods. And you'll notice that from 1970 until about 2015, they were very correlated. When you had low unemployment, you had a low deficit. When you had high unemployment, you had a high deficit. That makes sense because in recessions, tax receipts go down and federal outlays for transfer payments go up. But notice what happened in 2015. Unemployment fell from 2015 into 2020 before the lockdown, and rather sharply at that. And the unemployment rate went up as a percentage of the deficit went up as a percentage of GDP by a lot. And you'll notice that now we're back down, although we're starting to rise on unemployment at 3.9 unemployment rate right now. And you'll see that the deficit is starting out at this very high number. So during recessions, the deficit tends to go up by about 5 percentage points on average of GDP over this multi-decade time frame. But over the most recent 3 recessions, it went up more like 9% of GDP. And so we're looking at the government predicting 6.1. If we have a recession in 2025 or 2024, it's likely going to be more like 10 or 12% of GDP. And this is a big issue because, there we go, the federal interest expense as a percentage of federal revenue is skyrocketing. Thanks to all of this debt and all of the bonds that are maturing, we have about 17 trillion treasuries maturing in the next 3 years. And of course, higher interest rates. As the Fed has engineered the Fed funds rate up to 5 3/8, we're starting to see a verticality in the blue line. This is only through September, by the way. The year-end data, I guess, isn't available. And with the trajectory of this line, it looks like we're on a track almost certainly to take out the percentage of federal interest expense that is a percentage of interest expense as a percentage of federal revenue. It looks like we're going to go to an all-time high, almost with certitude, probably take out the 91 high of around 18%, probably this year. And this might be one of the insidious reasons why the Fed is a little bit more anxious than a lot of people think they should be to cut interest rates, because this debt rolling over has an average coupon. Some of the bonds that are rolling off were issued, say, in 2019 or 2018. They have coupons of 25 basis points or 50 basis points. And so the 5 years, for example, that were issued in 2019, they're going to be rolling over at a 400 basis point interest rate increase if interest rates stay where they are. And this is turning into an absolutely critical problem that we'll be talking about more in future webcasts. I don't want to dwell on it here. So here is the trajectory of the interest rate and the 10-year Treasury yield. So the blue line is the generic 10-year Treasury yield, which is at 4.09 right now. And then we see the moving average on there. And then the blue line, the red line is the moving average. That's a 3-year moving average. And then we see the Treasury interest-bearing debt total marketable type of number. So this is the Fed's tractor pull problem, that all this debt coming due and the interest rates are way higher than they've been in the 10 years prior to 2022 type of time frame. One of the reasons I think the economy is held up better than almost everybody expected, including me, is this chart where the monetarists have databases that show that when M2 goes negative year over year, it's a strong, very reliable recession indicator. And that happened, as your eye can sort of see, at the end of 2022 or so. And so people thought, well, it's gone negative. But I think the point that the monetarist economists missed is that the blue line was gunned so much higher than the trend from 2009 to 2019. It was a very steady rise in M2, but then all of a sudden, trillions of dollars get dumped into it. And that money is still there. You can see that we're nowhere close to trend on M2. And this is one of the reasons why I think that the economy did not revert to its usual recessionary characteristic right when the M2 went negative year over year. But there are things that are certainly storm clouds for the economy, and we're going to go through a few of them now. So I just gave you one that's a positive, but here's things that are recessionary signals. And here's the slope of the yield curve. And we have the 2-year versus the 10-year here. And when we're in the red shaded area, it means the 10-year yield is lower than the 2-year yield. And usually that happens before these red vertical shaded areas, which are recessions. This is starting to look a little bit more like the 1980s, not only in terms of that first chart I showed of the interest expense as a percentage of revenue, but it's also the duration of time that the yield curve has been inverted. It's a pretty long time period, and it's exhibiting that characteristic, which is always the really flashing red light for recession, in that it's shrinking. We were at 108 basis point inverted, and on this chart it shows about 39. I think it's as of today about 45 basis points inverted 2s to 10. So we'll be waiting to see if this line goes above 0. It hasn't done that yet. And so I think to be really confident in a near-term recession call, you need that red shaded area to disappear and turn into a 0 yield curve or a positively sloped yield curve. And we're in the process maybe of doing that, but it hasn't happened yet. Another early warning on recession that needs to revert before you have the red flashing light is the expectations of consumers in the present situation versus the future. And when the red shaded area shrinks, it means that their view of the present is getting more pessimistic, meeting what is always a rather pessimistic view of where the economy will be in about 12 months. We've been a long while in this area of very deeply decent expectations of the present and bad expectations of the future, but it looks like the yield curve, it's starting to revert, but too early to say that there's a near-term, an extremely heightened near-term recession view. Now, one thing that has started to flip, and I talk a lot about this, is employment. We see, this just goes back to 1997, but we've got those red shaded areas, and we see that when you cross over the 1-year moving average in a meaningful and convincing way, it's usually the start of a rapid rise in unemployment. And that just happened in the most recent employment report. We were right on the 1-year moving average, but the unemployment rate did go up by 0.9. One robin doesn't make a spring, and one month's crossover is not enough to be definitive, but this certainly has sort of the look to it. And so we're going to be watching this extremely importantly. I think with a lot of importance, I think that this is the most important economic indicator to watch as we go forward month by month. We also use the 36-month moving average, the 3-year moving average, and that's starting to get the look too. It's moving up, and we see the 36-month moving average is coming down, and it's coming down, fairly rapidly. And so we'll wait to see if this crosses over. We expect that absent, as a base case, we expect that this will cross over sometime in the next, say, 4 to 6 months. So we're going to be watching for that. This is really a puzzling slide. I'm going to talk about some of the puzzling things about a lot of these statistics that we're seeing. You'll notice that the initial claims since 2022 were pretty volatile. They were falling. Now that's because we had that spike due to the lockdowns. But I'm struck by how very, very stable this number has been for the past couple of years. It almost looks contrived to me. And I'm starting to think that there's a lot of economic statistics that are starting to lose some of the veracity that they might have had in past time periods. And one of the reasons I'm worrying about this, I showed this slide once before, is the survey data really trustworthy? You'll notice that back 10 years ago, the response rates on surveys, let's just take a look at the employment cost index. It looks like that was up at about 75%, and we see others around 2/3 survey response. And look what's happened to them ever since 2023. We see that we're getting something like half or 60% only of the responses. So you want to wonder, is today's survey data like the establishment survey, the unemployment number that comes out the first Friday of each month that gets all the attention, is it really as robust as it was, say, 10 years ago? I would have to conclude that it's a little bit more suspect. Also, there's other ways of looking at unemployment rates. This is the share of states with rising unemployment rate, higher unemployment rate versus 6 and 12 months ago. And we can just focus in on the one that is the tan type of line. That's the last 6 months. And it's 88% of the reporting districts. Now, there's actually 51 reporting districts because Washington, D.C. gets a report as well. But 46 out of the 51 reporting districts have rising unemployment over the past 6 months. And the ones that without rising unemployment are listed on the screen. Sure, okay, Pennsylvania, that's a meaningful size state. Sure, Texas, there's a lot of people in Texas. But then look at Wyoming, Minnesota, North Dakota. These are not the highest population states. So mathematically, is it even possible that these states can overcome the rising unemployment that we find in California, in Florida, in Illinois, in New York, in New Jersey? It'd be hard to make the math work just on using those numbers. So maybe we should put more emphasis, or not put sole emphasis on the establishment survey, but also put emphasis on some other employment data like this, which rather strongly suggests that the trend that's starting to show up in the establishment survey with that 12-month moving average cross, with the monthly number crossing over the 12-month moving average, maybe that is really starting to loosen up, and it's going to start going higher in the fashion that the establishment survey number versus moving average did in past recessions. We'll be watching for that. This is a certain recession indicator. This is the aggregate cyclical and non-cyclical 6-month change and recessions. And again, the red shaded areas are recession. And this type of divergence happens only leading up to recessions. It even happened leading up to COVID, oddly. It's weird how COVID made these recession indicators actually work, even though it was an exogenous event for sure. But we see the type of divergence that one should be on the watch for. Now, this is the household survey. I said the establishment survey comes out the first Friday. Well, so does the household survey. And the picture is radically different of the household survey. We see that the blue bars are total full-time U.S. employment, and they have fallen for the last 3 months in a row on full-time employment, especially December, which was a horrific decline that completely diverged with the establishment survey that showed growth. But we now have 3 months of full-time job losses. Now what we see is part-time workers are starting to shrink too. In the last 2 months, we've actually had a negative if you accumulate the two. And then we have part-time for economic reasons employment, which remains, that was negative last month too on the household survey, but isn't as negative as the full-time situation. So another divergence in this employment data that suggests that the rubric that there's this booming employment economy is contradicted by other areas if you want to look closely enough. Here's NFIB hiring plans by small businesses. Again, they show marked deterioration. Leading indicator for sure. So it's before the recession comes, it starts to deteriorate, but it has that look again. It has the look of the past two recessions, and it's dropping at a very, very steep rate in the most recent few reporting periods. Here's the unemployment rate and small business hiring plans. The blue line is small business hiring plans. The moving average is the darker blue line. And again, we have that look where it's coming down, and even the youth year unemployment rate, which we showed in some of the earlier slides, is hooking over. Here's average weekly hours worked in manufacturing, which is also sliding very quickly. And first they cut the hours, and then they cut the bodies. That's the way the economic cycle works. And so historically, when you have this type of a decline, one should be on the lookout for a rising layoff rate. So this is what the unemployment rate looks like over the past multiple recessions. Going back to 1949, we've only taken the middle two quartiles. And the black line is the median of those middle two quartiles. And again, the red line is the current situation. We're just positing that we're at the front edge of recession here. I'm not really predicting it, but I'm just saying, let's pretend that a recession starts next month. Well, it sort of has the look. You have to acknowledge that. In fact, it even looks like the median in the past. Some of those blue shaded areas showed sort of a false start of a rising unemployment rate that was just a precursor to what happened at the zero line. Here's the 2s, 10s spread, the yield curve spread, under that same methodology where we're looking at the middle two quartiles. And it sure looks like we've seen the maximum version of the yield curve. And it looks like we're moving along, but we're not in a recession yet. But it certainly has the shape of the idea that the Fed is probably going to start cutting interest rates here in 2024. The odds are not as high as they were at the turn of the year. There was actually a moment where the shape of the yield curve suggested 7 rate hikes of 25 basis points, or some other combination that gets you that same cumulative number. That's down to 3.5, 3 2/3 for this year at the present moment, because of the way in which the yield curve movement has developed so far in 2024. Here's wage growth and the quits rate. The quits rate is the red line. It leads the blue line. And the fit here, I include this one. I was debating whether to include this one, but the fit of this is just uncanny. How the red line leads the quits rate by 8 months so perfectly, and it suggests that the quits rate is going to go down to basically where it was, basically pre-pandemic. So we'll be watching for that. Now, also consumers are starting to show some signs of stress. We see that the auto loans, the number of accounts by loan type in auto loans is stable, and it is in mortgage loans as well, but not in credit cards. We've had a marked increase in credit cards, which obviously are used because people are short on money. Buy now, pay later. And here's the interest rate on credit cards. So with this large increase in credit card usage, the interest rate is up by, not surprisingly, about 600 basis points, because it follows largely the movement in the Fed. In fact, they've risen even faster than the Fed has raised the Fed funds rate. 23% is a really punishing interest rate level. And so I'm fearful that the credit card situation may lead to a pullback in consumer spending. Let's talk about inflation. CPI came out today, and we see that the core is at 3.8, so I did have it right at the beginning. And the red line is the headline rate, and that's at 3.2. Now, sure, they're down, but you'll notice that the core rate is decelerating in its decline and is still nowhere near the 2% level. And the headline rate has clearly stalled out. It hit a low back in the third quarter, I think, of last year, and then bounced up. And it's actually looking to be a little bit more tenacious than people were hoping for. One of the reasons for that is no doubt the price of oil has gone up this year by about 10%. When oil goes up by about $10, it's now about 10%. It's about $7. But if it goes up $10, it adds with a lag about 0.4 to the headline CPI. So there was hope that the headline CPI would get below 2.5 by the middle of this year. Under the current framework, it looks like we'll be lucky to get anything below 3% sometime in the middle of this year. So the inflation data has gotten to be a little stickier thanks to some rises in the price of energy. Here's the core CPI ex shelter inflation. You notice we're parsing CPI and inflation, PPI, PCE, every which way to Sunday these days. It used to be year over year, and then it was core joined year over year, and now it's core ex inflation. And now we're looking at 3 months annualized and 6 months annualized for all these various indices and subsets of those indices. You can almost pick whatever you want. So if those that want to be sanguine about the 2% target being potentially obtainable, you would use this one. So you take out food, you take out energy, you take out shelter. It seems like you don't have much left, but it is at 2.2%, close to the Fed's 2. So shelter would somehow calm down, and the OER has been higher than expected. For the past 2 months, OER has gone up non-annualized 1%. So it's annualized is at a higher than 6% rate. So that hasn't happened yet, which seems odd to me because there's a pretty good correlation between the Zillow rent index and the OER lagged by 12 months. You'll notice that the Zillow index, the red line, has come down very markedly from 16% at its peak to 3% at its nadir, and it's now at 3.5%. And yet the owner's equivalent rent is still way up there. And it surprised to be greater than expected over the last 2 months. And you'll notice that the blue line is kind of lagging. I suppose it could always accelerate its decline, but there's a big gap here. And for the Fed to hope to get to below 2.5% or towards 2%, you really need this blue line to get down by about 3 percentage points at a minimum. And so we'll be watching that. There is reason for hope, though. On a lagged basis, and that's the amount of multifamily units under construction is the highest of all time, it looks like, other than maybe 1973. It's awfully close to 1973. The gray area is single-family houses under construction, and it used to be that was the lion's share for most of the last 30 years. That was the lion's share of construction, but there's been a boom in multifamily units under construction. It takes years to build many of these larger projects. And so there will be pressure on rents, I think, to the downside rather than the upside when all of these units come online. So you have about 35% more multifamily units under construction than single family. So there might be a hope for those that are looking for rent relief. Here's the headline and core PCE that the Fed uses. Now, this is looking much better on the headline number. We're at 2.8 on the core index, and we're only at 2.4 on the headline number. And so this would be encouraging to the Fed. Unfortunately, the Fed has chosen, maybe out of hope, to use to be changing the way they're looking at inflation. You'll remember that at Jackson Hole back in 2022, the Fed started talking about supercore PCE. You don't hear them talk about supercore PCE, and the reason probably is that it's not looking good. On the 6-month annualized basis, which is a methodology they trotted out at the November 1st dovish rhetorical pivot, we can see that now if you annualize the 6-month number, it's not so good. It's gone up by a fair amount. It's now at 3.4%, no longer in the 2 handle. We see that year over year and 6 months are virtually identical. So the super core seems to have settled in at 3.5%, and so we haven't heard about that anymore. We hear a lot about price levels, and we know that the inflation rate was much worse at 9% CPI than it is today, at more like 3.2 on the headline. But this is the PCE, and we're just saying what's happened to your purchasing power if you had $1 like if you're living on a fixed income and you're getting the same amount of money, how much has your purchasing power been eroded by the growth in the PCE? And the answer is 14%. And this is why people still feel like there's a lot of inflation. It's because the prices are still high, just like the M2 money supply is still high. The prices are not, you're not eroding as quickly as you were in 2021 into 2022, but it's still eroding. And you've lost a lot of your purchasing power. I mean, if you have another 4 years of this, you'll have lost almost 30% of your purchasing power. So no wonder there's a lot of people that don't want to buy the idea that the economy has been fully repaired and that inflation has been conquered. So we also have the PPI, producer price indices. These are leading indicators of the consumer price index. And we see that the final demand year over year is 0.9, and the ex-food and energy number is 2.6. So there's nothing really that scary in here. Even the ex-food and energy it's near a local low. And the headline number, there's virtually no inflation at all. The ones I like, I always talk about this, import and export prices, because they're not seasonally adjusted, they're just prices. And we see that we've been negative on both export and import prices for a while now. I guess it goes back maybe 18 months or so. We're still negative. They are deflating at a decelerating rate, but they're still negative. So there isn't a lot of inflation problems. People are still, they're still dealing with these high prices. So let's talk about commodity prices, which I've been kind of negative on since basically 2022. And we see that the red dotted line, that's the 200-day moving average of the Bloomberg commodity price, it just can't get above, on a sustained basis, its 200-day moving average. And we're pretty far below the 200-day moving average right now, although it has been moving up in the most recent couple of weeks. The commodity price complex does not show an inflationary impulse, and that must imply that there is not very good global growth. And that's true. There are many countries in Europe that are in recession, and there's, US is doing pretty well. India is booming, which I've recommended as an equity investment for quite some time. But globally, there's not a lot of economic growth. Let's talk about some parts of the Treasury market. Here's just the chart on a 30-year US Treasury bond, sort of a constant maturity sort of a thing. And we see that the yield got down to 70 basis points intraday, the all-time low, and had a rise up of about 450 basis points or more. And we see we broke out of that channel. I've talked about this for years. We've broken out of this channel, and we've seen a little bit of improvement. The yield did come down somewhat from the middle of October of last year. But amazingly, if you own the 30-year Treasury at its high point back in price, back in 2020, you're still underwater 46% on the price of that security, a 46% loss. It was as bad as about 55%. We've had a nice price increase, but the hole was so big that we're still near the bottom of the hole rather than getting more normalized. So we are not really seeing much of a movement in yields over the past few months, several weeks, I should say. On a year-to-date basis, yields have been in a range, depends what part of the curve you look at, but it's about 40, 45 basis points or so. And we're about 15, 20 basis points closer to the high of the year-to-date period than the lows, but it's been very low volatility. And that's allowed spreads of credit sectors to come in a lot. And we now see there's a narrative that's going around that spreads are tight, but that's okay because people are indifferent to spreads. They just like the yields because the Treasury base case yield is somewhere around 4.25%. And you can throw on 300 basis points of high yield. And it's high yield's a little wider than that. But if you just threw on 300 basis points of yield to the Treasury spread, you'd be up at 7.25%. And so the new narrative is, well, people don't care about the spread. They just care about that 7.25%. They like that. And that's dangerous because it shows a sign of complacency. When people just say, I don't really care about valuation anymore. All I care about in the case of some high-flying risk investments is momentum. And when it comes to the lower parts of the credit market in bonds, they say, well, at least the absolute yield is acceptable to me. I've seen that strategy end badly multiple times in my career. Here's the Bloomberg investment grade aggregate bond index, the so-called yield to worst. And we can see that the rate rise was pretty severe, 470 basis points, and we're still pretty elevated. yields at 4.76%. So you can get yields in a very safe way with things like mortgage-backed securities or the total return bond fund, where you're getting yields that are closer to the 6% than a 5%. And so you can get that advantage without taking a lot of risk in the investment grade bond market. I always look at the copper gold ratio, even when it's completely not working, which has been the case since basically, in a certain sense, since the lockdowns. So we see that the blue line is the copper gold ratio, dividing the price of copper by the price of gold. And over the past year, the copper gold ratio has declined to nearly a new local low, or perhaps one. And we see that the copper gold ratio, the 10-year treasury yield has gone up over that time period. But just like in 2021, there was a big difference between the two that got closed fairly quickly in 2022. We now see that big gap. So either we're going to see commodities go down, or we're going to see either see copper go up and gold go down, or we're going to see yields come down. We'll see what happens, but this has not worked at all over the past, I'd say, year. Let's talk about the bond market. Here's some credit market metrics. This is just year to date as of March 4th. So we see that the big winner is CMBS BBB, something that I recommended pretty strongly in the past couple of webcasts. That's the number one performer, up 6.7%. Then we see loans down in the CCC category are up 4.3. That's a pretty big return for CCC bank loans. Then we see BBB CLOs, which are repackaged bank loans, are doing just as well as the junky bank loans. So that's been a good risk-adjusted area to be. And then you got a lot of 1.5 percenters in various parts of high yield, BB loans, AAA CLOs. And then you've got the high yield stuff that's up a little bit, the fixed rate high yield bonds. And then you've got the investment grade stuff, which is not doing well. We see investment grade AAAs, there aren't very many of them, but that's the worst performing sector in the bond market this year. And then we see investment grade AAs, there's some of those, that's second worst. And then we see agency RMBS is down about 1.8. Interestingly, the Bloomberg Treasury Index is only down 1.4. That's a reversal of what it looked like last year when corporate credit outperformed by a lot. That seems to have pretty much run its course, although most of these losses are not due to anything other than duration, the fact that interest rates have risen on the various key rates on which these bonds are issued. Now let's take a look a little deeper in the weeds. This is the high yield market. This is the BB spread versus the BBB spread. So if you go down one notch in quality from BBB investment grade to the first tier of junk bond BB, how much are you getting paid to do it? The answer is historically not very much. We're at 80 basis points right now. The lowest on this display going back 20 years is 45 basis points. So there might be a little toothpaste left in the tube, but you'll notice when it got to 45 basis points and got near there again in 2007 or so, you'll notice it didn't last very long and it bounced up pretty quickly. So this would be a bad environment to be dipping down in the BB corporates out of BBB corporates, in my opinion. Now we'll take a look at the internal spread in the high yield market from the BB, which is the highest rated junk bond rating, and CCC, which is the lowest that's not in default. And we see that this has narrowed, but nowhere near as much. This has come down from about 850 basis points down to 550, so it's in 300, but it's certainly not historically super low. I'm not really saying that this is a good time to be going into CCC corporates, because the reason the spread is so wide is the market has begun to anticipate defaults. The Fed has been vocal about higher for longer, and one of the ways in which that works to slow the economy, bring inflation down, and have the Fed then cut interest rates is by having defaults, and by having marginal players in the economy. You know, unfortunately, they're often medium and small businesses end up getting squeezed by these interest rates. Bank loan borrowers as a total were borrowing at about a 4% interest rate 3 years ago, and many of them now have to borrow at a 12% interest rate. And those are loans that reprice every 90 days. So they're paying that big interest rate right now, and they've been paying it, and they're gonna have to keep paying it unless the Fed cuts interest rates. And that will be the mechanism by which the unemployment rate will begin to go up at a more rapid clip that perhaps, as I talked about earlier, has begun. Here's agency mortgage spreads. This is just the guaranteed mortgages, and they're wide. They're wider than a 25-year average. They're in from nearly 200 basis points when the market was avalanche with supply back in the middle of last year. But now there's not very much supply in the market because the existing home sales and home sales broadly are very, very slow thanks to the high interest rates and the high home prices. But we're still at 144 basis points. As I've pointed out in past webcasts, that's with the prices of mortgages no longer at premiums where you have to worry about getting paid off early. They're at discounts. So you don't have any extension risk in the mortgage market because prepayment rates are very slow, and you don't have negative convexity in the mortgage market, which means that you have as much upside as downside for a symmetric move in interest rates. And that's a really great attribute that is rare over the past 35 years of the agency guaranteed mortgage market. So these are really attractive. And so they've lagged the corporate bond market thanks to the demand for corporate bonds and the lack and the quantitative tightening perhaps that's going on with the Fed. But these are very attractive on an absolute basis and a risk-adjusted basis. We'll look at some other asset classes. We'll see the improvements. We've got the black line, which is the Bloomberg CMBS index. That's a AAA rated index. And we see that spread is in a little bit. But look at that purple line. That's the CLO AAA index. And that's in a lot. I mean, that's in 100 basis points over the past year or so. We saw the very good performance that has continued this year with CLOs doing very well. And that's something that we own in lieu of corporate bonds. And there's been good outperformance there year to date as the fund is off to a very strong start here in 2024. I think we're hoping to have an advantage of 100 basis points this quarter alone. I think we're about 70 right now. So we're moving in a very good direction. Here's CMBS versus corporates. We just check into it. CMBS is when you're above the red dotted line, CMBS is cheaper. The AAAs are much cheaper than they've typically been versus AAA rated corporates. Then we see single A CMS versus triple B corporates. And we see there that we're still very wide. CMBS remains cheap, even though that spread has come in. There's room for this to improve, although one does not want to index in the CMBS market. You want to be very careful in underwriting because you don't want urban office concentration. That problem is nowhere near solved, and it's going to be a long slog to get that to improve. So we have a very strong, as I think everyone in the industry knows, CMBS team, and we've had fantastic performance. We have an ETF that just does CMBS, and it outperformed a CMBS index last year by over 300 basis points. Here's the just to round things out, here's emerging markets and what their yields look like. That spread was hanging out at about 500 basis points for quite a while in 2022 into 2023. And then finally, with the risk rally that started November 1st with the Fed's rhetorical pivot, we really saw emerging markets finally join the risk asset party. And we ended up having a pretty good experience in the second part of last year, although Total Return Bond Fund does not own emerging market bonds, but our emerging market bond fund obviously does. And our core DBLFX also owns emerging markets, although we're not at a maximal position at all because we'd be waiting for the dollar to weaken to get bullish in that regard. So with that, I'm going to turn it over to Andrew Sue, who's going to go through the Total Return Bond Fund in detail. And I'll be back to answer thematically the many hundreds of questions I already got, and I'll go through them, and I'll be back to answer some of them, and we'll wrap up. Andrew, take it away.
Yeah, thanks a lot, Jeffrey. And you spoke a bit about commercial real estate, and I'm going to pick up where you kind of left off there. On this next slide, looking at commercial real estate, I mean, there are still, there's a lot of challenges out there in the market still within this space. But in terms of delinquencies, more recently, we've seen delinquency levels plateau in pretty much all categories other than the office sector. Our base case is that delinquencies will continue to rise here. It will be led by the office segment of the market, but you may have some dampening effects from the stronger subsegments such as industrials. But the base case expectation is that we will see further degradation within the commercial real estate space. Now, there's really been a dearth of transaction volume in the commercial real estate space. And without the transactions, there's really not as much market clarity. And as market clarity becomes murky, this has led to some unfair assumptions, we would say, that we're starting to see in the market, or we have seen in the market. One example is only several months ago, investors in this space, they operated on a blanket assumption that essentially all commercial real estate loans coming due would be unable to pay off at maturity. Well, on this page, we're showing this conduit segment of the CMBS market, and the bars here represent what percentage of loans are paying off at maturity. Pre-COVID, these numbers were in the 90% range, meaning 90% of the loans that came due were essentially paid off. Now, despite all the headwinds that we have seen recently, rate hikes and such in 2023, we see that 80% of commercial real estate loans that came due were paid off. The 20% that didn't pay off doesn't necessarily mean they were defaulted. As a matter of fact, many of them have been provided extension options, so they can find a better exit outcome on the back end of this really troubling time in the market. Now, recently, we've seen some of the punitive expectations being dialed back by the market. Jeffrey showed earlier some of the very strong returns within the CMBS market. CMBS investments have done very, very well, I'd say, over the last 3 to 4 months, especially at the senior level. And we'll continue to watch the data to see if there's any other relaxing of these really punitive assumptions that are out there. Some of you may have been surprised by the payoff rates that we saw in commercial real estate last year in the previous slide. But what's even more impressive is I would say that this happened against a backdrop of very low CMBS bond issuance. So in 2023, you can see some of the volume here across the different years. The pace of rate hikes made lending a real challenge. But expectations is for CMBS issuance to rebound this year. We've already seen $15 billion of issuance just in the first 2 months. If this keeps up, it certainly would be positive for the market and likely increase appetite for lenders to perhaps step back into this market. If this does continue to play out this way, it would further dispel this whole notion of mass extensions within this market, and certainly that would be a catalyst potentially for higher valuations within this space. 2 charts on this page. On the left, the pie chart shows the percentage of the DoubleLine total return bond fund exposed to commercial mortgage-backed securities. This is as of February month end, and you can see that there's 7.3% total exposure into commercial real estate in the fund at this point in time, and this is just the sum of the dark gray and the beige segment of the pie. We've had a lot of questions from investors about office exposure in particular, and justifiably so. So we further separated out the office exposure within the portfolio, and that's less than 2%, 1.7% of the total fund, so not very much at all. Now, on the right side of the page, it depicts our commercial real estate holdings by asset type. I'm not going to get into the nuances of each one, but the takeaway here is that you can access this market in a defensive manner and still achieve very attractive returns. So to visually depict this resilience, I just want you to draw your attention to the bars over conduit, SASB, and CRE, CLO investments. You would need the blue bar to completely be eroded away by losses before you're at risk of losing even $1 of principal. And here we're comparing the beige bar to that blue bar, which is the 60 days or more delinquent. So in all cases, the delinquent loans are only a fraction of the overall credit enhancement or credit protection here. So these positions are very well protected at this time. The table immediately below, you can see that these positions are at discount dollar prices, and even factoring in for losses in our base case, our expectations are close to double-digit returns for these investments. Shifting gears here, now we'll take a look at just the residential mortgage market. Here, we're looking at convexity of 2 different indices, the mortgage-backed securities index, or the MBS index in black, and then the agency CMO index in blue. In the mortgage market, we use the term convexity, and it's a measure of essentially upside to downside risk. And if you compare where the indices were back in 2021 to their location now, both of these indices are showing considerably better convexity or optionality today. Between the 2 agency CMOs, they offer the most positive optionality currently. And this is really where the yellow dotted line comes into play. The yellow dotted line is showing the fund's allocation to CMOs over time. So DBLTX's allocation to CMOs over time. As a reminder, similar to the most generic agency mortgage-backed investment, CMOs are also government guaranteed. They are AAA rated investments. The one difference I would point out is that they are, or there are some structural elements to CMOs that give us the ability to manage both rate and spread exposure in a more nuanced fashion. We've been investing in CMOs for over the last 3 decades. It's fair to say that we're quite experienced in this space. And, as we increase allocation, clearly we're seeing some tremendous value in this market, hence the focus on agency CMOs rather than just generic pass-through securities within the mortgage-backed securities market. On this page, we're taking a look at the components of the total return bond fund, and these are the red diamonds. And we compare them to the yields across the entirety of the Treasury curve. And this is depicted with the blue line across the screen. Often we talk about the barbell nature of the fund, where we're balancing interest rate risk or interest rate exposure with spread from the credit components within the portfolio. On this chart, everything to the left of the 5-year part of the curve is our credit exposure. These are assets that are positioned towards the front end of an inverted Treasury curve, so they are benefiting from the higher short-term rates, and they contribute attractive yields to the overall portfolio. One thing to note, though, we have been focusing on higher quality assets, but we haven't had to sacrifice yield as spreads are quite wide in the structured credit space. We're able to obtain pretty attractive spreads and yields in certain pockets of structured credit markets today. To the right of the 5-year part of the curve, we're looking for assets that contribute yield, but also add this positive optionality to the portfolio. I spoke about it just on the previous slide. Government guaranteed mortgage-backed securities are uniquely positioned to offer this now. And then in conjunction with the structured credit assets that we've been buying, these do pair very well to create a portfolio that offers attractive yield, but also tremendous upside potential via price appreciation. Looking at just a snapshot of the fund in comparison versus the index, a few notable points here. First, discount dollar price for both the fund and the index. But we'll see in just 1 minute, much of the discount securities that make up the total return bond fund are in the government guaranteed mortgage space. So, in the past, a lot of people are concerned about prepayment risk, and that historically has been a risk to the mortgage market. It's actually a very big incentive now for our investors because these are government guaranteed assets, and the nature of that dictates that they will be repaid at par. So any prepayments on discount security essentially gets you back to 100 cents on the dollar faster, and that certainly is a positive. On the duration side, slightly shorter versus that of the index. We've been actively managing duration using some of the agency CMO positions. And unlike just using treasuries to manage duration, this does give us access to duration, but also contributes additional spread for a government guaranteed asset as well. Last thing I would point out is just the yield. Yield advantage of 130 basis points. We are using high quality credit assets at the front end of the curve, and this has been a really big contributor in terms of adding some additional yield to the overall portfolio. Looking a little bit closer at duration over time, we have come off our historical peak in duration back in the fourth quarter of 2023. You could see it here, but our goal here has been to deliver the best risk-adjusted return to our investors. What we don't see is the duration of the index. Historically, we have always been shorter than that of the index, or I should say at least not meaningfully longer than that of the index. And that has helped us generate attractive returns with lower volatility. As mentioned, portfolio positioning, we are focused on quality. Majority of investments are in government guaranteed assets. Agency mortgage-backed securities are particularly attractive now, and hence the overweight, and these are the agency pass-throughs, agency CMOs, and even the agency CMBS that we include in our mandate. The credit in the portfolio is very well diversified, also with the focus higher in the capital structure, so very protected as well. Last slide for me, before I hand this back to Jeffrey. Similar study we did with the CMBS earlier. Here, we're looking at the entirety of the credit book. Credit protection is shown in the blue bars, and then serious delinquencies in red. All sectors do have considerably more protection than loss expectations. Structured credit, it continues to offer relatively wide spread versus other areas of fixed income. So we can maintain a yield advantage while moving up in quality and having a really resilient investment portfolio if, in the case, the economy turns. So with that, perhaps I'll hand it back to Jeffrey here and address some of the questions that have been coming in. Thank you.
Thanks, Andrew. Yep, I've seen some themes in the questions here. One of them is less of a theme, but I'm going to answer it anyway. And that is, do I still think we're in the fourth turning? And if so, which inning? I think if you understand the four turnings, and Neil Howe's book, the fourth turning is out now. I mean, it's pretty obvious that we're in a fourth turning. And that means, I talked about this for years and years, that the institutions that have been in place for generations will be challenged. And I think everybody can agree on one thing, that those institutions are being challenged and will continue to be under pressure. And we're going to have to restructure our unfunded liabilities or debase them, one or the other. And that's coming, and it's not coming in a generation. It's coming in the next several years at the most. So the fourth turning will turn into the first turning, which will be a great thing, hopefully, but it should be a great thing because we'll get our house in order and our productive capacity and distribution of wealth in sync. And that should be coming really, I'm going to say by 2032, I would say at the latest. So it speeds up. I think the fourth turning doesn't last as long as the prior ones because there's so much need for change that it just has to suddenly happen. At first it starts, like in The Sun Also Rises, How'd You Go Bankrupt? It starts gradually and then suddenly. So that's where we are. Someone says, when rates were at historic lows, why do you suppose the government didn't issue debt at those low rates? Bad management. I think short-term considerations dominated because short-term interest rates were basically at zero. And so, yeah, you could have locked in 30 years at 2% interest cost, but 2% is higher than zero. And so I think it was a big mistake. I agree with the theme of this question. One could cut them a little slack by saying, well, if they'd issued a lot of debt longer, maybe long rates would have gone up more and that would have hurt things. I mean, maybe that factored into it as well. Someone says, this is a theme that's prominent here. Is there a possible scenario where short-term rates go down from Fed policy, but longer-term rates go up due to inflation and excessive deficit spending? That's essentially my base case, but not the next move in the chess game. I think the economy is certain to weaken, as we saw in all of those economic charts that I showed. And I think that the Fed is talking about cutting interest rates. We're down to about 3 now, 3.5 on the WIRP, but we'll see. So short-term interest rates should probably come down, but then I think there will be an aha moment. Maybe the 10-year will drop down. Someone asked, do I think it's going to 3% on the 10-year? I don't think it's going to 3. It might go to 3.25, but I think at some point around that 3.25 yield level, or 3 to 3.25 to 3.5, people are going to have a crack of doom moment where they realize what's going on or needs to go on related to the question that maybe the yield curve will get very steep because nobody will want to own anything but a very high real interest rate on the long end. And the inflationary policy response could very easily be a very family identity, same as the last 2 recessions, where they collapse interest rates, but the deficit goes way up, and people start to realize that we can't afford that interest expense. If we get a recession by 2028, we're going to be talking about this problem that interest expense will go to 30, 40, 50% potentially of tax receipts under today's tax code, which of course can be changed. Everything can be changed. I've come to learn as I've gotten older, when you're 12 years old, you think nothing's ever going to change. And then when you get to a certain middle age, I don't know, say 45 or 50, you start to realize that exactly the opposite is true. Everything can change. So the Treasury debt can be restructured in radical ways. I've talked about this in speeches. I'm not going to go into it a lot now, but if you come to any of my events where I speak live in front of a couple thousand people, we often talk about the math of what's going on here, which I did go through a little bit in my Just Markets webcast. And then finally, this brings up a good point. There's been a lot of immigrant job growth, a lot of immigration in the country, some legal, but most of it not. But they say, could that be offsetting the chart you had regarding states with job losses? No, they're counting jobs, they're not counting people. So I don't think well, unemployment's going up. I mean, job growth being high would not lead to high unemployment. But it is interesting that over the past 3.5 years, under the Biden administration, there's been a shrinkage of U.S.-born jobs. The number of jobs is actually down, and of course, the number of non-U.S. born is way up. It's responsible for all of the job growth, which is really kind of a remarkable statistic. But I do think the baby boomers have something to do with that. I think a lot of the reasons that the domestically born number is going down is we have a lot of retirements in the baby boomer cohort, and they're really not being replaced at the same level. So thank you for your attention today. I remain very heavily invested in many of my firm's funds, but the one that has my largest allocation by a lot is the DoubleLine Total Return Bond Fund. And I remain extremely comfortable. I'm very concerned about risk with my own personal investments. So we have delivered very high risk-adjusted returns in the Total Return Bond Fund and the strategy that preceded it at another firm for a very long time. And I look forward to continuing that as we move forward into what started out very strongly as for 2024. With that, I'm going to say good evening to you all, and thank you for paying your attention, and thank you for your interest and support of DoubleLine, and goodbye.